Ladies and gentlemen, good day and welcome to PG Electroplast Limited Q4 FY24 results conference call hosted by JM Financials. Ladies and gentlemen, certain statements in the release concerning our future growth prospects are forward-looking statements, which involves a number of risks and uncertainties that could cause our actual results to differ materially from those in such forward-looking statements. We will now undertake to update any forward-looking statements that may be made from time to time by us on our behalf. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need an assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Agarwal from JM Financials. Thank you, and over to you, Mr. Agarwal.
Thanks. Good evening, everyone. On behalf of JM Financials, I welcome you all to PG Electroplast Q4 FY24 earnings conference call. Today we have with us senior management represented by Mr. Vishal Gupta, Managing Director of Finance, and Mr. Pramod Gupta, Chief Financial Officer. So without taking much of time, I would like to hand over the floor to the management for their opening remarks, post which we open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Deepak. Thank you, everyone. Good evening, everyone. Thank you for sparing your valuable time and joining this call today. Hope all of you are doing well. I am joined on this call by Mr. Pramod Gupta, our Chief Financial Officer. We have already shared our results presentation earlier and hope you must have gone through that. Financial year 2024 has been another remarkable year in growth journey of PG with many milestones. Company has been able to deleverage its balance sheet and raise funds via QIP for the next phase of growth. Company has also forged a new JV partnership for the TV and hardware business, and the JV company Goodwork Electronics was selected for IT hardware PLI 2.0. Operating revenues for the company grew 27% and crossed 2,746 crore rupees, with product business contributing around 61% share in the operating revenues. EBITDA also increased by around 52.3% and stands at around 275 crore rupees, and net profits rose by around 77% to 137 crore rupees. Company has posted industry-leading growth in the products business, and operating revenues for product business crossed 1,668 crore rupees in FY24 with 24% growth. This is despite the fact that average selling price, that is ASP, in certain categories is down by up to 8% on YoY basis. The room AC business contributed 1,317 crore rupees, which is a 26% growth on YoY basis. The washing machine business had a growth of 20% on YoY basis, and coolers operating revenues were flat, largely because of steep fall in ASPs. Order book and visibility for product business remains robust, and the company is on track to accelerate product business growth significantly in current financial year also. PG's new product offerings in washing machines and room ACs have been received very well, and we have got very good response from our clients. The company is focusing its efforts towards developing cost leadership while striving for product leadership too. Company continues to see increased interest for business from new and existing clients, and we remain very confident on the future growth prospects of the business. For FY25, our operating revenue guidance stands at least 3,400 crore rupees in PGEL and another 600 crore rupees in our JV company Goodwork Electronics, implying 4,000 crore rupees of group operating revenue, which is a growth of 46% over FY24 numbers. We are also guiding for consolidated net profit of at least 200 crore rupees in PG Electroplast which is a growth of 46% over FY24 net profit of 137 crore rupees. The growth in products business, that is washing machines, room air conditioners and air coolers, is expected to be around 44% from 1,668 crore rupees in FY24 to 2,400 crore rupees in FY25. CapEx guidance for FY25 is in range of 370 to 380 crore rupees, and company has planned to further expand room AC capacity by setting up a new integrated unit in Rajasthan. The company is also expanding their washing machine capacity from 1.2 million units to 2 million units, with a new greenfield facility being planned in Greater Noida. The Supa facilities will be expanded further with new building and further capacity enhancement for room AC business. As suggested by several investors to improve the liquidity in the traded shares, the board of directors have approved the stock split in the ratio of 1:10, implying that each 10 rupee paid up share will be subdivided into 10 shares of rupee 1 each. Also, board of directors have approved the final dividend of 20 paisa on each split share of 1 rupee face value. I would like to reiterate that company remains committed to improving capital efficiency by improving asset turns through product business growth, and we aim to deliver industry-leading growth with best-in-class return ratios in coming years. With this now, I will hand over the call to my colleague, Mr. Pramod Gupta, our CFO, to elaborate on the financials. Thank you.
Hello and good afternoon, everyone. I'm sure you have seen the financials in details already. We have had a good scale-up during FY24 from operations point of view in a very challenging environment. The ASPs in the RAC, washing machine and coolers were down significantly due to low commodity prices during the year and especially in the fourth quarter. Also, the business in the first half 24 suffered due to unseasonal rains, and despite these challenges, we have posted industry-leading growth in RAC revenues of 25% for the full year. The company's operating margins and operating revenues for fourth quarter were up 30% in revenues at 1,077 crores. EBITDA grew 56% at 120 crores, and net profit rose 78% to 71.6 crores. During the year and fourth quarter, we saw improvement in the margin largely due to cost control, lower commodity price, and operating leverage. On balance sheet, net debt has declined by almost 325 crores in the fourth quarter, in the full year basis, on a full year YoY basis. During the year, company has done significant capex in commissioning new greenfield plant in Bhiwadi, new building in Supa in the PGEL premise, and we have also acquired NGM for 65 crores, thus assuring the land and building availability for future growth in Supa. As stated by Vishalji, we have guided for 370 to 380 crores of capex in the coming financial year. This will be funded largely by internal accruals. Again, reiterating that improving capital efficiency by sweating existing and new assets will be the key focus area for the company in the coming years and quarters. We remain very optimistic on the growth opportunity in our area of focus, and we believe company is well placed to expand its market share further in the coming years. With this, I'd like to open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we have a first question from the line of Nikhil Kale from Invesco. Please go ahead.
Yeah, thank you for taking the question. Firstly, congratulations on a very good set of numbers. Sir, can you just repeat the AC revenues? I'm sorry, I missed that. For the year?
AC revenues for this year was 1,317 crore rupees.
Okay.
For FY24, yeah.
Got it. And how are you, what is the outlook for AC revenues? Obviously, the year has started on a very strong note, but at the same time, we also have new facilities coming in for some of the larger brands. So what is the outlook there, and how are you seeing the growth in RAC for FY25?
Sir, still, for this current financial year, we are again targeting at least 25 to 30% growth in our RAC revenue also.
Got it.
Minimum 35%, yeah.
Okay. And again, that will be coming in from some of the larger brands, or again, you're looking at multiple smaller brands giving you...
So it's a mix of large and small brands. We will not be able to give you exact breakup of that because of obvious reason, but we are targeting at least 35 to 40% growth in our RAC numbers for FY25.
Got it. And sir, can you just help us with the incentive numbers? So both on PLI and whatever state incentive that you might have received, if you could just help me with that number.
So we have already received PLI of rupees 15 crores in FY24, which has been recognized in our last balance sheet and the P&L. Coming back to your question, I will tell you the demand is looking very good in AC business. And in fact, the industry itself is very pleasantly surprised with the kind of end consumer demand. And we are seeing that channel inventories are at a very low level now. So we see this year going to remain very healthy for AC business.
Okay. And sir, the PLI incentive you mentioned, the state, the capex that we have done, the incentive, we will also get some incentives on that, right? That will start from next year?
Yeah, this we are targeting that we should start getting these benefits from current financial years.
What could be that amount, sir? Any sense in that?
It should be around 40 to 50 crore rupees, probably. Yeah, it should be something around that, 40 to 50 crore rupees.
Got it. And sir, just on the margin profile, obviously the margins have been very strong, but with the new facility coming in, how are you looking at margins? Do you think that in the near term there could be some dent, given that the initial part of the year you might have limited costs?
So you have seen our...
No. Let me just, sir, let me take this question. First of all, coming on the incentive, this year the incentive was about 15 crore from PLI and about 4.7 crores net from the previous capex that we did in PGEL. Next year onward, in the first year, we will get something like 35-40 crore rupees minimum in the for the PLI, for the state government benefit, and 30 crore PLI. And coming to the operating margins, actually next year in the company PG Electroplast, operating margins, we are having a slight upwards bias for the full year. And one of the main reasons for that is that TV business, which is a low margin business, is no more a part of PG Electroplast. So on a full year basis, actually we are hoping that we will see some improvement in the margins at the operating level.
Got it. So Q4 it was part, right? Or Q4 also it was not a part of the business?
No, Q4 it was a part of TV business, was very much a part of the PG Electroplast. In fact, even in Q1 we will see some contribution from the TV business, because what happened was that there was some inventory of the kits which was lying in the PG Electroplast. They are getting sold out and cleaned out in PG Electroplast. So maybe about 30-40 crores of turnover will come from TV business in PGEL in the first quarter, and that will be it. After that, TV business contribution will not be coming in the PG Electroplast.
Got it. Thank you, sir. I'll get back in the call.
Thank you. We have our next question from the line of Vipra Srivastava from InCred Research. Please go ahead.
So, hi, I'm audible, right?
Yes, very much.
Yeah, just a couple of questions. So, this incentive of 20 CR, which you have told from PLI income CapEx, how has it been accounted for?
There was a cash incentive which has come, so it has come as a part of the revenue. So it is a part of the operating revenue.
Cool. And so, secondly, so this whole 20 crore, right?
19.7 crores, yes.
Okay, cool. Noted. And secondly, sir, you have also told that next year also will be getting some incentives, right? I missed that. Can you please repeat that? And secondly, the accounting will be same, right? It will be part of the revenue, right?
Yes. So there will be a PLI of 30 crores and 35 to 40 crores of state government incentive.
Okay. So total 65 crore will get incentive next year, right?
Yes.
Okay, cool. Noted. And last question, sir. You have also told that you have seen some improvement in margins due to lower commodity prices. So if you can quantify it roughly, how much would that be? Because because copper prices are going up now, so that might not repeat. So a quantum for that, if possible.
In our business, although quantum is given in the presentation also, if you look at the raw material cost on a full year basis, for us is actually down by almost 2% or so. I'll just read out the exact number. On a full year basis, it is a 1.35% improvement in the cost of raw material as a percentage of revenue versus the same percent last year. But if the copper prices go up, then our sales also goes up. Actually, in our business, as I have been explaining, it is the fixed amount per unit which I get to make a product. I don't get a percentage. So raw material is a pass-through, and optically the margins look better if the cost of raw material goes down, and they look little worse if the cost of raw material goes up. But nonetheless, because my mix is going to change for better, because our TV was almost 10% of the revenues this year, more than 10% of the revenue, I am expecting still some bump up in the revenue at the operating level from the in the overall business.
Okay. Thanks a lot, sir. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to strictly 2 questions per participant. Should you have a follow-up questions, we request you to rejoin the queue. We have our next question from the line of Pranay Roop Chatterjee from Burman Capital. Please go ahead.
Good evening to all present. Am I audible?
Yes, I understand.
Great, sir. Sir, next year you have mentioned the number of 65 to 70 crores of total incentives. My question is, how much of these incentives are you built into the 200 crore PAT guidance?
So they are built in about the same amount, 65 to 70 crores versus 20 crores this year. So there is an incremental 45 crores, and you have to look at PBT on that basis, because there will be a full tax which we will be paying about 20% on these incentives also.
So that implies ex PLI actually there would be a very marginal bottom line expansion. Is that a fair statement, and any specific reason why that is so despite strong revenue growth?
No. We have given that as a minimum this thing. So if you see 65 crores is what you are saying is going to be the total incentive versus 20 this year. So there is an incremental of 40. But out of that 40 also 20% tax is going to be there. So effectively 32 crores is the incremental number which is probably likely to hit the bottom line. Okay, 32 crores versus my profit after tax is going to go up from 137 to at least 200 crores. So which is like about 65, 70 crores almost. So you can assume about out of that 32 is coming from the incentive, and rest of it is from operational. And this is a minimum that we are expecting right now, and as the year passes, we will update you if we are seeing better numbers than what we have guided. In fact, April and May month have been very, very strong for the AC sales this year, and if that continues, we'll probably see how we have to talk about the guidance in the coming days.
Thanks for that, sir, but I'm slightly confused. Just going through the numbers again, and 45-46% top line growth, EBITDA will obviously, margin will see an improvement because TV is going below PBT. And basis the explanation you gave, 135 crore of PAT going to 200 crore, this jump, and you explained part of that is PLI. So if you take out the PLI, it comes to only like 20 to 25% growth, which is the organic portion. So I'm just trying to understand 40 plus top line versus 20% bottom line.
No, you are getting it wrong. See, in the company, PG Electroplast, the growth in the business is going to be 23% or 24% from 2,700 crores to something like 3,400 crore. Okay. So that is about 24% growth. And I have assumed that margins are likely to be flattish to slight positive. I have not assumed a huge margin expansion, although there will be an upward bias because of TV business not being there. And I am saying then apart from that, there will be a incentive which will be there, and overall 200 crore minimum profit is going to be there.
Got it, sir. Very clear. Next question is on Goodworth Electronics. So I just wanted to understand, I think this has been discussed previously as well, but how exactly is Jaina Group going to add value to this JV, both in terms of TV and hardware? Like, will they be able to bring in substantial new business? Is there any other benefit that will bring to the business? Because the TV business has been shifted to the JV, right? And attributable PAT will be lesser for PG minority shareholders. So I'm just trying to get a sense there because I did a bit of digging in Jaina. They seem to be mainly a distribution business. They probably have some manufacturing footprint as well. They have some connects with Chinese contract manufacturers in other equipment. So if you could just help us from your perspective, from minority shareholders' perspective, what is the value add from Jaina in this deal?
See, as we said initially, Jaina first of all had a Google ODM license, which only two other people have in India. One is Dixon and one more company. So that comes into the JV because of the JV with Jaina. Second thing is that they have very good sourcing capability because they have been the promoters earlier of Carbon brand, and they still own the Carbon brand. So they have very good sourcing capabilities in China and good relationship with the large ODM and OEM suppliers in China, and especially in the TV and mobile handset and even laptop, etc., which we are going to do in this company. On the forward side also, because they themselves are a good decent brand, which they do about 7-8 lakh TVs every year. So large part of it is going to come to this JV for manufacturing. And because of the scale that we gain immediately in this company, in the TV business, we are able to attract a lot of brands. And I can tell you, within next 1 year, you will be seeing tremendous growth happening in this business. Last year, we did totally 3.5 lakh TVs in our own company. In this company, within very first year, we are targeting at least 7 to 8 lakh TVs, and I'm very hopeful that in the next 1-2 years, this number will look even bigger than that. Much bigger than that.
Got it, sir. I'm sure I'll be stopped soon, so I'll be quick. In terms of the JV, which is 50-50 currently, how much has PG invested or is going to invest both on the TV and IT hardware side, and is the 50-50 split going to remain so even in the visible future?
Yes, 50-50 will remain so in the visible future, although they have an option after second year to convert 1/3 of their shareholding into the PG Electroplast shares at the same valuation price to earning multiple as the PG is trading, and then it can become a majority shareholding of PG in that. That is the option that they have after second year. Right now we have invested close to just about 6 odd crore rupees in this, but we may invest another 5-6 crore rupees in the JV for the TV business. Also, by the way, they bring a lot of their sourcing capabilities. So in this company, we are getting open credit from some of the Chinese vendors for TV kits, which on our own we would not have been able to procure. So that sourcing capability is the advantage that Jena brings to us in this JV.
Got it, sir. And last question, any update on IT hardware PLI orders?
I will be updating you maybe after this election and things are over, because clients, we are in talk with several clients, but none of the clients are making any decisions. They are all waiting for the policy and political clarity to happen. And hopefully in the next 2-3 months, we will be updating you more on that. We have made some small successes, but nothing to talk in a very big way. All are still in the stages of discussion and some due diligence, etc.
Thanks a lot, sir, for answering the questions, and all the best.
Thank you.
Thank you. The next question is from the line of Yash from Stallion Assets. Please go ahead.
Hi, thank you for the opportunity. My first question is that could you broadly give us an idea of your EBITDA margins across the three main segments of electronics, plastic molding, and products?
So this year, you can say plastic molding is about 7.5% margin business. Electronics is about 2%. And then rest of the margin, whichever way you look, is coming from the product business.
I see. And next year, sir, how do you see the mix evolving given the strong growth that you're seeing in your product segment? Do you think your majority, like let's say 70% of the revenue would still be on products?
Yeah. Product business will continue to drive the growth. We don't expect the plastic component and electronics will actually decline because of the TV business going away, and the other business, which is plastic molding and components, is likely to see probably about 10-15% growth. So overall growth is going to be driven largely by the product business, where we are expecting, and we have given a explicit guidance that at least 2,400 crores kind of a turnover we see in the product business next year versus 1668 this year.
Got it. And so last question would be, given the strong demand we've seen on RACs in Q1 FY25, how should we look at the seasonality, this year?
So the seasonality still remains very much. It's just that seasonality has shifted towards from the business used to start in early December, and then it used to end till April end or May mid. Now this year the business has started late January and is probably continuing into the late June as it looks like.
Got it. Okay. Thank you.
Thank you. The next question is from the line of Bala Murali Krishna from Oman Investments. Please go ahead.
Yeah, good evening, Mr. Kaushal. So, regarding any new products we are planning to add, like air conditioners for railways or any other products we would like to add in the near future in addition to the RAC washing machine?
Actually, there are several discussions with certain clients which are going on, and we are in active stage of discussion, and there are several other opportunities which are also on the doorstep of the company, where we are still evaluating some of them, and in some of them we are negotiating with some clients. As and when some of these materialize, we will update you, but I can tell you the kind of inquiries, RFQs and RFPs that are there is very, very high, and we will be updating you once some decisions happen on such inquiries and opportunities which we are seeing. But we are in active discussion on many other new segments at present.
So just to follow up on that, so railway AC also in the discussion, or it is not under discussion?
Which is, what is it?
Air conditioning supplied to railways for the bogies.
No. We are not looking at railways as of now. That is a little different segment. We are mostly going to concentrate on the consumer segments largely, and we are going to be focusing on business to business segments, not business to government yet. So we are little choosy on that segment that we will be probably continuing in this area.
Yeah, that's a good one. So on the regarding this hardware section, so when we can get some contribution, I don't know whether we are already producing laptop kind of things or not. Not when we can get some contribution from that, when we are expecting, and what could be the margins in this laptops?
Yeah. We will be surely updating you on those numbers. We will see some contribution in the hardware PLI this year. We have made a small success in one of the clients where our due diligence has succeeded, and we have got a final go through, but they have to still place their first order, and we are hoping that in coming months we will see something in the hardware PLI from that client. But in other clients, it is only the discussions which are happening, and there is nothing materialized as of yet. Everybody is waiting for probably this election to get over and then take some decisions on manufacturing it in India or continue to source from other countries as of today.
Yeah, and lastly on margin side, so on an overall basis, so we had on around 10%, but in Q4 we had on 11.1%. So in the FY25, which one we can see that we can do beyond 11.1%, or it will be between 10 to 11? Any broad idea is no need of ballpark number.
Yeah. I'll just want to highlight here and caution everyone that, ours is a seasonal business, so when you look at on a particular quarter and extrapolate it, probably it's not the right way, because we have a little higher exposure to the summer products, which is AC and coolers and fans and maybe refrigerator components. On the component side, refrigerator. So quarter 1 and quarter 4 are typically very heavy, and then operating leverage kicks in them in these quarters. And quarter 2 and quarter 3, typically there is a slightly lower margin because the operating leverage works other way. So please keep that in mind and always keep the full year margin as a benchmark, and we hope to do better than that in the coming years, surely on operating level at on a full year basis.
Thanks a lot. That's all from my side.
Thank you, sir. The next question will be from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Firstly, congratulations on a great set of results. Hope I'm audible.
Yes, sir, you are audible.
Yeah. Hi. So, sir, just wanted to, a lot of my questions have already been answered. So, just wanted to know, so our CapEx is planning around 370 crores. So, what kind of an asset turn could we expect, and will this CapEx be completed itself in FY25? Some color on that would be helpful.
So, as we have been saying that we will require, we want our fixed asset terms to improve, and we think that at least 4 to 4.5 is minimum that we want in any new project which we are looking at. This year, incidentally, the fixed asset terms are looking slightly lower than last year. The reason being is that most of the capex got capitalized in the fourth quarter, and there was hardly any contribution from Bhiwadi as well as the new NGM factory which we acquired in the fourth quarter. So assets have come in and there has been no revenue contribution from them. So that should actually see an improvement going forward as these assets start contributing towards the revenues. Next year's capex, we hope to complete significant part of it in the next year itself. One of the major expansion which is happening is actually in the infra build-up, basically the land and building for future growth areas. This year, probably we are going to be building almost close to 1 million square feet to take care of the future growth opportunities that we see on the horizon. And therefore, that is eating away a lot of the capex in the coming year. out of the 380 crores that I talked about, almost 180 crores will be, or 170 crores will be going in the land and building. And we hope that we should be able to complete significant portion of the building in the next year itself.
Fair enough, sir. That was very helpful, sir. And so just one, maybe on a broad base, sir, we've been, doing fantastic numbers in the last 3 years. So just wanted to get a sense that now also we're guiding for a great growth. So over a long-term period, maybe 3 years, 5 years, what kind of a run rate could we, look at? Like, are we looking at, what kind of a CAGR growth are we looking at?
I mean, that kind of visibility we do not have, but we can draw some inferences from the segmental growth in which we operate, how they have panned out in other countries when the macroeconomic changes have happened like they are happening in India, and we remain very optimistic on both AC, washing machine, TVs, as well as the new categories which we are pursuing. And we think that penetration levels are still very low. We think that we could be seeing even from here few times revenues in the coming 5 to 7 years, because the penetration levels of AC just remains about 7-8%, washing machine 12-13%. So that kind of numbers will eventually go up as the spending power goes up. So the CAGR revenue should be very healthy in the medium to long term, in our opinion, which is like 3 to 5 years or 5 to 7 years. We think we should see very healthy growth.
So, sir, in FY26 also we will be able to do FY25 type of growth, sir? If so maybe next 2-3 years we could have substantial growth and then we would maybe come to a normalized rate. Would that be a fair way to look at it, sir? Or maybe for the next 5-6 years we'll go all guns blazing?
I think our growth is going to be tied up to the industry growth. If industry does well, we do typically better than the industry always, because we have been gaining market share. And we think that if the industry grows at about 15-20%, which we are very optimistic it should, then we should be doing better than that in the medium term in the existing product lines.
Oh, okay. Fair enough, sir. That's it from my side, sir. Thank you. All the best, sir.
Thank you.
Thank you, sir. We have our next question from the line of Kaushik Mohan from Ashika Stock Broking. Please go ahead.
Hi, sir. Congratulations for the good set of numbers. Sir, it's a simple question. I just wanted to understand, this year we have done around 137 crores. So we have also received a PGEL of 15 crores. That means that post taxes it will be somewhere around 11.8 crores. That means we have done exactly business-wise it is 125.4. So we are guiding next year to be around 200. That means that we have a PLI benefit of 40 CR. 40 CR ka minus 21% leaves out to be as 168.4 crores. That means that we are talking about a 35% growth. Am I right?
Roughly to that extent, maybe little, the number is like 30 crores is a PLI, and another 30-35 crores minimum should be the government incentive, state government incentive. So on that you take out something like 20%, 21% tax out, and then whatever remains is the growth you can assume, if you want to look at that way. Also, I want to highlight here that we are assuming not very high margin expansion next year, although we think that margin will be expanding because TV business contribution is going to be lower. So overall, we hope that we should be able to surpass this 200 crore guidance, at least that's what we have given, and we will be updating you more after the first quarter numbers on both top line and on the margins. Right now, whatever business plan we have, we are doing slightly better than what we expected in the month of April and May.
Got it. And sir, can I get, if possible, can I get the volume growth? Because as per our scuttlebutt understanding, we came to know that AC prices per unit has been gone down drastically. So just we wanted to understand, because our margins is intact and we have a fixed cost passover for the client. So we'll be having an EBITDA, fixed EBITDA per unit. So can I understand what is the volume growth from last year to this year?
Yeah, just
On
give me 2
ACs,
minutes.
washing machine and other. Yes, sir.
Yeah, just give me a second. I'll do that. In the meantime, if you have any other question, we can take that. And
Yes. I have another question. So I just wanted to understand, like how much are we in our entire total revenue on the AC part and the washing machine part, and also on the air cooler. How much is going for the branded players and how much is going for the private level players, if it is possible to give?
yeah, almost 80 to 85% is going in the AC to the brands, and about 15 to 17% is going to the private labels. In the washing machine, it is slightly on the higher side. Private labels are close to about 35% and brands are about 65%. Now coming to your volume growth in washing machine, the volume growth was about 24%. The volume growth was about 12%. In outdoor units, volume growth was about 51%.
Sir, if possible, can I get the unit number also, if possible?
Unit numbers we have stopped giving actually, but we can take it offline, okay?
Okay, sure, sir. Sir, last and final question. I just wanted to understand the branded and the white good players. Where do we get the higher margin? Do we get it from the branded player or do we get it from the white good players, from the private level?
No, the margins are very similar. The pricing or the conversion cost that they give is actually similar in both brands and white good players. It's just that white good players, most of them do not intend to have their capacity, and they are slightly better because they are doing sole sourcing, or they may be doing sourcing, totally outsourcing they are dependent on, and therefore there's no risk of seeing any business going away because of their capacity coming or those things. But margins wise, there is hardly any difference.
Got it. And sir, which is the best company that I can assume for us to be a peer, sir, in the peer side?
We have a slightly different mix. So in washing machines and TVs, we are competing with Dixon, and in AC, we are competing with Amber. And therefore, it's a slight mix of that. Now, actually, Amber has also got into washing machines. Now, let's see what happens next year, because they have invested in ResJet. So we can be actually compared to Amber in some of the bigger overall things, because for us AC is still the largest segment as of today.
Got it. And sir, when we look at compare with the peers, our employee cost is slightly being higher. I understand that I've seen the practice, so I understand what's happening. But can I understand, like, do we have, because currently we have expanded so much capex and all. So on an OPEX side, on the employee cost, how much it will be increasing going further?
The employee cost should grow in line with the revenues. In the last 1-2 years, there has been significant portion in employee cost, almost 10 to 12% in the last 2 years, which is coming from the hit on account of ESOPs. So we have given quite decent ESOPs. Almost 200 people in our company are covered under ESOP, and we have taken about 15.5 crore hit this year, which is a part of our employee cost because of that ESOP, and therefore our employee cost looks slightly higher. And also we are in the expansion phase continuously. For the last 3 years, we have been expanding very rapidly, and some of the facilities we actually where we create new capacities, we are not able to utilize them fully in that particular year, and therefore those employee costs look slightly higher. So which is the case this year. Bhiwadi has actually not contributed, but we have the full team which was employed in the month of in the fourth quarter, and their costs have come in.
Got it. Thanks, sir. I'll get back in the line.
Thank you. We have a follow-up question from the line of Nikhil Kale from Invesco. Please go ahead.
Yeah, thanks for taking my follow-up question. So just going back to the incentive, I think all of us are kind of trying to look at the core profitability excluding incentive. But would it be fair to assume that when you are now kind of quoting prices to customers, you are in a way quoting lower prices given you are the leader of PLI incentive, right? So to that extent, you would have passed on some of that benefit to customers in the form of lower prices. Would that be a fair understanding?
No, it is not exactly a fair understanding. Actually, there's nothing like that. Our pricing is almost same as the competition, or slightly, in some cases, slightly better than competition. We are not compromising on the pricing because we have some cost advantage or we have some PLI benefits as of now.
Mm-hmm. Okay, but is it a lever that you could potentially use in the future going forward, or no, that is something that you're not?
Future, I don't know, but as of now, we have not done any such, there was no such requirement to go and undercut for the pricing because we have a PLI benefit or because we have benefits.
Okay, got it. And sir, just lastly, I think you mentioned some of the companies that are kind of in the same domain. For example, Dixon is now also talking about getting into, say, PCB assembly. You obviously are expanding into newer product segments. Any thoughts on looking at that segment or nothing?
We are already doing PCB assembly, and we are supplying the kits in basically the controllers we were supplying for AC this year. We have started. So we are doing PCB assembly in controllers, and now we have started doing PCB assembly. We were earlier also doing for the TV motherboards. So that continues, and we will be looking at other opportunities which will come our way in coming years.
Got it. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one question per participant. Should you have a follow-up questions, we request you to rejoin the queue. We have our next question from the line of Aditya Gupta from Tara Capital Partners. Please go ahead.
Hi, good evening, and thanks for taking the question. Sorry, I think, at least for myself, I'm a little confused with the PAT guidance, and sorry to keep coming back on this. I will try to answer it in the past. So, again, looking at core, right, 120 crores is what you have done this year, excluding the PLI. And if you add the 70 crores of PLI on top of this for next year, 30 plus 40 from states, that itself takes you from 200, if I know that off, takes us down to 130. So what part am I not understanding correctly over here?
First of all, this year numbers, out of the whatever 137 crores, there is already a incentive which we take, and we are not following any different practice than anybody else. Everybody in the industry, in our industry, is getting some sort of incentives from the state and central government. So these numbers are very much comparable, like on like. Yes. That is one. Second thing is this, that you are getting it all wrong because the incremental incentive next year is going to be probably close to 40 to 45 crores only. And then on that you have to pay tax also. Hello?
Right. So, yeah, no. Yes. So, yeah. Let's knock off the PLI benefit for this year, and let's assume the 120 crore is the core PAT for this year, right? Ballpark speaking.
No, it is not going to be 120 crores. It will be probably something like, 120 crore, 119 crore rupees is going to be the profit after tax, the tax of PLI and the other benefits.
Okay. And this should at least grow by the 45% or revenue growth, even if you assume the margins to be flat at the PAT level, plus whatever added benefit that you get, right? Next year.
Yes.
Is that the way to look at it? All right, thank you. And the second part is on the state benefit and on the PLI, what is the timeline and how long are we expecting these benefits for?
See, the state benefits are going to continue for 10 years, maybe 12 years from next year, starting this year. and PLI is going to come for next four more years.
And the run rate will be?
Pardon?
The run rate for these will be annual run rate?
The PLI is actually not a fixed run rate. It is amount which has been decided depending upon the targets getting met. So if we meet all the targets, then next year the number is in 25 we should get 30 crores. After that 36.5 crores. Then year after that 51 crores, and year after that 60 crores. The last year is 60 crores. In case of state government benefits, first year is going to be little bump up, maybe 35-40 crores, and then year after that every year about 20 to 25 crores.
Got it. For the another 10, 11 years, right? And both of these you will be reporting in the revenue line, right?
Yes. Everybody does that practice. We were actually following earlier a different practice.
No, I'm just clarifying it for myself. I'm not saying you're doing something different. Yeah. Okay. Thank you for clarifying this again. I'm sorry to harp on it. Thank you.
Thank you. We have our next question from the line of Devashish from Swan Investment. Please go ahead.
Hi, sir. Good evening. Thank you very much for taking my question. I'm audible clearly?
Yes, very much.
Sir, only one question I need to understand. So, currently we have a ROC of around 17-18%, right? So when you get into a new project, so what is the kind of target? Do we target EBITDA margin of 10-11%, or we look at ROC of 17-18%? And is there any target that is there in the management's mind of pre-PLI or post-PLI ROC that we have?
So typically, right now, first of all, I want to correct our PL. According to our calculation, ROC is about 21.6% on a last year basis. And I have given the calculations in my presentation. You can go through it.
Sure.
That is one. Second thing is this, that whenever we take a new project X of PLI and on a conservative basis, we are looking at least 15 to 16% ROC, pre-tax ROC, the way I have calculated. And that is the basic benchmark for us before taking up any new business or any new project in our company.
Okay. And the second question is, do we have any plan to getting into high margin, low volume businesses like aerospace and industrials and stuff like that?
As of now, we are not having any such opportunities which are coming our way. If there are any opportunities, which we will surely consider. Okay. Provided they meet our return ratios. Criteria.
Okay, so it's like even the higher margin businesses, despite having higher margin, you think the ROC is lower there?
In some of the cases, if the asset terms are not adequate, then margins will not be sufficient to take care of the return ratio.
Okay, understand. One last thing is a repeat of the first question. So any target ROC that you have in your mind for FY25 and 26? As capex has already been done, although you are still doing some amount of capex in next year and next year also. But any targeted ROC that is there in your mind?
We will like to have a slight improvement in the ROC which we report, and we think we are on track to achieve that. We are hopeful that we will be able to maintain this ROC of about 20% pre-tax ROC, which we are continuing to do right now.
So, is it fair to assume that with the kind of growth and some amount of margin improvement by FY26 or 27 will be able to achieve 25-26% kind of ROC?
It will actually depend on the growth and how the seasonality plays out. See, seasonality plays a very important role in our business. If the seasonality is not very stark and we are able to utilize our assets better, then the number you are saying is very much possible.
Sure. Thank you very much for answering my question, sir.
Thank you.
Thank you. We have our next question from the line of Farokh Pandole from Avita Fund Managers. Please go ahead.
Yeah. Hi, Pramod. Congratulations on the great results.
Thank you.
My first question was, what's our current net cash position? And in relation to that, clearly, once we navigate the next year, the capex should, from what you said, fall substantially in the year after.
So right now we have cash balance of about close to 180 crores. But right now we also have a gross debt of about 360 crores. Now this cash and cash balance will be getting utilized because some of it is actually earmarked totally for the purpose for which we raised the QIP. So we cannot utilize for any other purpose. So this year that thing should get over maybe by second or third quarter. And I'm very hopeful that out of the 370-380 crore capex which we are planning this year, significant part, almost 90%, should be internally generated. Okay, so we will not be seeing any increase in the gross debt level, hopefully, despite the higher turnover and higher capex in this coming year.
Right. And the capex in the year after?
Year after, things should actually depend upon how the business pans out this year. I'll tell you what is the reason why we are doing such a heavy capex. As I told you last year, this year we are doing a huge capex on creating an infrastructure, which is land and building for future growth. We are seeing some very exciting, huge opportunities coming at our doorstep, which we are in the active stage of discussion with significant clients, which are looking to shift their work to India from China, and some clients which are looking to actually expand their relationship with us. Now, because of that, we think that we are getting into a phase where the growth could be accelerating in the coming year, and we may be short of infrastructure for growth because ready sheds are not available typically for leasing out, and therefore we need to create some of those optionalities for us, and that money is going into creating those optionalities, and that we should be able to utilize most of it in the next 2-3 years, in our opinion. So we have purchased a land in Bhiwadi, another 8.5 acres. We have purchased another land in Noida, and in NGM, which we acquired, where 12-acre land was there. We are building almost 450,000 square feet of construction for taking care of any of these new opportunities materializing, so that we have the ready shed and where we can actually host any new business which comes.
Right. So again, the following year, clearly capex should be a lower number, significantly lower number than what it will be for the current year.
Yeah, it will actually depend upon the growth. If we get growth, we are not going to say no to growth because we are not wanting to. We are looking at, say, for example, this year, as I'm saying, like the product business is going to see probably 40% plus growth versus about 22-23% this year, with 23% this year we did. So we are preparing ourselves for any opportunities which we get in the coming year.
Got it. And my second question was, about 6 months ago, there was a lot of talk about the volume sort of augmenting by a lot of the large players in the air conditioner space. And in that connection, given the fact that this year the season is much longer, it's very sort of hot. You mentioned that the inventory levels were very, very low. So where do we stand on both of these sort of contrasting sort of forces? And I know that obviously you guided strongly for the next year, but given that now you have some better color and you've seen some of these capacities going live, how are some of these clients behaving?
So we are seeing industry overall being slightly short of the capacity in the industry being slightly short than the monthly demand, which we saw in month of April, May and June, probably April, May. Also, there was a little bit of a planning shortfall. Nobody actually anticipated such strong growth in the demand, and therefore people were probably not ready to take care of such a huge, I'll say, demand, and therefore probably in the coming weeks or we will see some stock outs in some of the major brands, probably because the material is just not there. And I think another very important sign on demand, which we hear from our clients, I am actually not doing the end sales, but what we hear from our clients is that we are seeing a lot of first-time buyer in the AC, especially from tier 3, tier 4 cities and even villages, and which is a very, very good and important sign, because that means that probably AC is going to see a good secular growth, and the I'll say the trend which we all were waiting for, that there will be a time like which has happened in other geographies where continuous growth of 20-25% kind of growth has been seen for a decade or so in China, for example, in the period 95 to 2000, early till 2010. That kind of number we could see for the industry in India. So that could be a possibility if this trend continues. And surely affordability is increasing, and we think that industry will be probably short of capacity if this trend continues for a year or so.
Okay, great. Thanks very much, Pramod, and wish you all the best for the coming year.
Thank you. Thank you.
Thank you. Ladies and gentlemen, we will take our last question from the line of Srinidhi from HSBC. Please go ahead.
Yeah, hi. Thank you for the opportunity and congratulations on great set of numbers. Just on growth guidance, a very strong 45% kind of a growth guidance in product business. Would it be possible to share more color on this growth guidance? I think you alluded a lot to AC business, but if you can share some color on the washing machine business growth guidance, what is really driving that?
We have been telling you all that we have added some very strong clients in the last 2 years, the AC, and that ramp up has started happening. We are seeing on a monthly basis some very strong pickup, and we think that both AC and washing machine should grow at about 40 to 45% this year. Washing machine is because of the client addition that we had and the ramp up which we are seeing. In case of AC, the first half is going to be very, very strong for us, largely because of the fact that last year, because of the unseasonal rains, we saw a lot of demand destruction in the first and the second quarter.
Yeah.
And then the demand actually recovered only in the fourth quarter. So that base is actually playing out well, and we are seeing some very strong ramp up and some very strong demand in the month of April and May, which we will likely to see continuing in month of June as well. So therefore, we are very hopeful that the number which we have guided, we should be able to easily achieve.
Great. Amazing. And also washers, sir, how much is the scale of business, and it's entirely ODM business, is it?
Yeah. Washers is a 100% ODM business. We are right now, as we have said, 313 crores for the turnover last year. We think that number should scale up significantly in coming years.
Okay. Thank you for answering my questions, and all the best.
Thank you. Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today, and I would now like to hand the conference over to the management for the closing comments.
Thank you everyone for joining the call, and I just want to highlight and reassure that management is committed to having industry-leading growth with best-in-class return ratios in the areas of focus for the company. And we think that we are very well placed now with our capacities, our capabilities, and the infrastructure investments which we have made in the last few years. And thank you all.
And one more thing, if you have any unanswered questions, they can be taken up separately over a call or over an email, please. You can connect us through Deepak from JM. Okay.
Thank you. On behalf of JM Financials, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.